Okay, so let's finish up here talking about 2008 financial crisis. We'll talk a little bit about what's been going on in financial markets during the COVID era, and then we'll maybe we'll have a little bit of time at the end of class to talk about your exam. So if you remember, right before break here, we talked about the three elements of financial risk. For some reason, I erased the last two, but didn't talk about. Didn't erase this one, but you know, the three elements were all this financial innovation, right? Particularly, right, financial derivatives and securitization that led to the subprime market, kind of created this big bubble. We have all of that global savings glut, right? So big increases in savings that led to this, you know, hugely inflated market. And then we have, you know, essentially too many people thinking that this time it's different, right? Not thinking about all the risk, including that fundamental risk, the risk that we've never seen before, right? And as I said, there were so, talking about like, what was the fundamental risk that was ignored? And I would say it was probably, I mean, things like counterparty risk were definitely there, but probably the fundamental risk was there were so many people before 2008 that were saying, it doesn't matter what all the crap is in these mortgage-backed securities. There's no way that the entire US real estate market could crash at the same time, right? So many people thought that that was just an impossibility. Why? Because there is no US real estate market. That's what many people said, right? If you've ever fiddled around with real estate, or if you have somebody in your family who works in real estate, you might have heard the old adage, what are the three most important things in real estate? Location, 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 right? And by saying that, what are they really saying? There is no national market for real estate. Everything is local. Everything is local. So the market in Mount Vernon has nothing to do with the market in Iowa City, has nothing to do with the market in Cedar Rapids, certainly has nothing to do with the real estate market in California or Florida. So the idea was that even if some markets were inflated, even if Florida and California was inflated, even if those mortgages, some of them went bust, there's no way that it could happen everywhere. And so you would still have some protection against diversification. But that's not what we saw. Right? And because of the subprime market, this was taking place everywhere, right? So even if there is no such thing as a national real estate market, all of these individual local markets got inflated. And they got inflated so much that when things started to crash in one market, people said, if Nevada's inflated, I wonder about Florida. And they saw the same things there. And so all of these markets started kind of cascading down the line, crashing. So, you know, that's kind of the fundamental risk, right? We have never seen that before in the US. We've never seen the entire national real estate market tank because, you know, quite honestly, and I think most economists even agreed with this, there is no national real estate market, right? So what's the chances that all of these markets would crash at the same time? So when they crashed, what happened? Well, when they crashed, who's in trouble? When real estate prices crashed, people stopped paying on their loans, right? So a lot of loans are what we call underwater. We talked about that this morning, where the value of the house is now less than the mortgage, so people just walked away. When they walked away from these loans, who then was in trouble? Right, well, first, the mortgage-backed securities were in trouble, right? Because now they're not getting payments in to then make the payments on the bonds, right? So first it was the trouble with mortgage-backed securities and the people who held them, but then of course, who held mortgage-backed securities? In some sense, everybody, but certainly banks and investment banks, right? And so basically it was the collapse of housing which led to the MBS collapse, which led to banks, and particularly investment banks. Really, I should really just say investment banks first. But of course, when investment banks started tanking, are investment banks separate from commercial banks? No, as for the reasons we talked about this morning, right? They're increasingly related. So the losses here, right? You can just kind of think about the losses cascading through the system. Eventually leading to the banking crisis. Of course, as the banking crisis takes place, this is a weird graph. I'm not 100% sure where I'm going with this. But as the banking crisis takes place, there's even bigger increases in risks, right? And even more, banks definitely start credit rationing. They stop lending money out. But of course, what happens when banks stop lending money out? That only feeds the housing collapse even more. Because now nobody can buy a house. Even if you want to, you need to, you can't get a mortgage. And so I'm not really doing this very well, but you can kind of imagine a circle here, right? A vicious circle. And that's often what financial crises look like. They look like this vicious circle, right, of losses leading to failure, leading to increases in risks that lead to more panic selling, which leads to more losses, on and on and on and on in a vicious circle. So by the time that we got to the end of this, and of course I'm skipping a lot of the details here in the interest of time. Shoot. Sorry, I thought I had a handout for this, but I don't. I'll just explain it. So if you looked at before the crisis, the 14 biggest financial institutions in the United States, of those, 5 of them disappeared or were essentially merged with others, right? So about a third of the big financial institutions in the US disappeared. The biggest was Lehman Brothers, right? Which was the second biggest investment bank that failed, that outright failed, right? So it went out of business, right? But others like Bear Stearns, which is the 3rd largest investment bank, got bought up by JP Morgan, right? So some banks ended up getting much bigger, right? Particularly JP Morgan and Wells Fargo. They were 2 of the better positioned banks, and so they suffered the beginning of the crisis fine and were able to kind of eat up the weaklings, right? But yeah, it was a pretty dramatic transformation, right? A pretty dramatic transformation. Having said all this, we didn't have an outright collapse of the entire financial system. I mean, while it was a banking crisis, it wasn't a full-blown banking crisis in the sense that we lost. Well, it wasn't a banking crisis like what we saw during the Great Depression. During the Great Depression, we had a third of all banks fail in the United States, right? So while a number of banks failed, it wasn't a banking crisis like what we saw in 1931 and 32. Why wasn't it worse?
The monetary policy.
Right. right? If we think about this relative to the Great Depression, right? Why wasn't this worse? Clearly, the Fed was a lender of last resort. Okay, so at the beginning of the crisis, they thought the way to increase liquidity was to lend to banks in trouble. Pretty quickly, they realized this is not going to work because there's just too many banks that are in trouble. And so they very quickly transitioned to another strategy. And that was instead of thinking about liquidity on a bank basis, they began to think about liquidity in the market. And so the Fed turned to not just lending money to banks, but buying bonds, buying these mortgage-backed securities, buying any kind of distressed asset. The Fed said, we're going to create some demand for these things. Because there were times during the crisis when prices on mortgage-backed securities, some types of mortgage-backed securities, essentially went to zero. There was no demand for them. Nobody was buying them. Nobody knew what the risk was. So the Fed said, well, we'll buy them. We will provide some liquidity, right? We will go out and we will buy these things. Now, of course, when many people heard this, they thought, oh, this is just another Fed bailout and this is moral hazard. This is going to cost billions of dollars. Did it cost billions of dollars? The Fed made a mint on this. The Fed made money hand over fist on this. Because what did they do? What do you do during a crisis? You buy, right? This is the old, if you really want to buy low, you buy during a crisis. So the Fed's objective here was not to make money, but that was just a happy accident, right? The Fed bought a bunch of these mortgage-backed securities at this distressed prices and basically made a killing on this, right? Once again, that wasn't the goal, but that was one of the happy accidents, right? So the Fed created a lot of liquidity, and we're going to see this when we talk about what's happened during COVID, is that the Fed is applying those same lessons here to COVID. The Fed has said, we are interested in market liquidity. We want to make sure that markets keep working. If the market keeps working, then the banks will be okay, right? But if the market breaks down, then we're in trouble, right? So the Fed has seen as its goal to buy different types of assets to make sure that there's some liquidity in the system that way, right? The Fed also cut interest rates to zero, essentially, and left them there for a long period of time. These two were with the Fed. What else happened? Fiscal policy, right? We had the Obama stimulus. Well, actually, technically, we had the Bush stimulus, and then we had the Obama stimulus. So if you remember, 2008 was an election year. So this was taking place mainly under President Bush, right? Obama didn't get into office until January. The peak of the crisis was really in September and October, right? So Obama didn't become president until really after the peak of the crisis. So the Bush stimulus was a series of tax cuts The Obama stimulus was about half tax cuts and half increases in government spending. Of course, this became a big political issue, but when economists think about this, did this help a little or a lot? It probably helped a little, but it didn't help a lot. And one of the reasons was it was too little. Right? This stimulus was only about 3% of GDP. So during a recession, I say, oh, I'm going to give you a nice little check of 3% of your income. Is that going to change much for you? Probably not. And it didn't change much for the economy either. So there's a lot to be said about this. I'm not really going to get into it, other than to say that despite, there was kind of panics in the streets among some conservatives that, oh my God, this is going to drive us into ruin or whatever. It was actually pretty little. Relative to the size of, for instance, some of the stuff that the government has done during the COVID crisis, this is small, right? This is much smaller than the stimulus passed under Trump in March and April, right? Much smaller. So yeah, it wasn't a lot. The much more impactful thing was the bailout, right? TARP. Treasury Asset Relief Program. Treasury Asset Relief Program. So this was a fund of about $700 billion. $700 billion to essentially bail out the banks. Now, there's some really great stories here about how this process went down. You probably don't remember some of this, but initially, in the midst of the crisis, this program was put forward by the Bush administration, and it went to Congress and it failed. And I can remember watching the vote on Congress, and you could see the no's and you could see the stock market. The no's go up and the market crashed. It basically, while Congress was voting on this, the market crashed by about 10%. And so after it failed, everybody in Congress said, oh my God, this is horrible. We got to vote again. And so they voted again 2 days later, and this time it passed. But it gives you some idea that this was not popular to begin with, right? This was not popular. And so part of the reason it wasn't popular is because I still don't think most people understand it. People in the Bush administration didn't even understand it, okay? So the Treasury of the Secretary, Lance Blankenship under Bush, who had worked in Goldman Sachs. So it's kind of surprising to me that he doesn't understand some basic things from money and banking. But he proposed that we take this money and we just give banks loans. Let's just give banks some loans. Right, so we're going to give them some cash. And then that will solve the problem. And Ben Bernanke, who's the chairman of the Fed and an economist, said, you've got to be kidding me. Don't you understand anything about banking, right? If you just give banks some loans and some cash, what happens to their leverage? You give them more assets, but if you don't give them more capital, what happens to their leverage? It goes up. They actually become riskier. Banks actually become riskier if you give them loans, right? So that's not to say they're not going to take it, but this is not going to do anything for their leverage. If you want to reduce leverage, how do you help the banks? you give them capital, all right? And so that was essentially the Obama plan, or we could call that the Vista Bernanke plan. And so what the government did is they forced every bank, even banks that weren't in trouble, they forced every bank to take preferred equity from them. What's preferred equity? Preferred equity is like equity, but there's a couple of differences. First off, you have no voting rights. So the government said, we're not going to take any voting rights. And then preferred equity by its name tells you something. There's actually guaranteed dividends, and you get the dividends first. So basically the government said, we're not going to take any voting rights, but you're going to have to pay us back first, right? So preferred equity, it ranks very high in terms of who gets paid off if the bank goes belly up. And this was the way to do it, right? As we know from money and banking, right? You've got to reduce leverage. If you're going to reduce risk, you got to reduce leverage. And so this was the way to go about doing it. One of the things, as I said, they made all banks do it, whether they wanted to or not. And that was part of the psychology of this, right? Is we're not going to let you tell us whether you're in trouble. We're going to tell you everybody's in trouble. Everybody's going to take equity, right? There were a couple of effective things about this, but the most important was, you know, when it comes to bailouts, it's better to do something sooner rather than later. Because as I showed you in this little cycle, that picture, the longer the cycle goes on, the deeper you're going to be, right? And so history has shown us if you're going to do a bailout and try to break that cycle, to do it early as opposed to later is much better, right? And so TARP took place relatively quickly, right? But of course, you know, that was one of the problems with it, is it didn't go through the usual political channels, right, of being debated by politicians and the public. I know the public still doesn't understand that. One of the things that the public doesn't understand is how much did this end up costing taxpayers? 700 billion? 600 billion? 500? $10? In the end, the government made a little bit of money on this, right? Now, they didn't make a lot, in part because some of this money went to Fannie Mae and Freddie Mac, right? We talked about those government-sponsored organizations that help subsidize mortgage-backed securities. Those had an implicit guarantee from the government that the government had to back up. So, you know, if you kind of separate them from banks, the government made big money on commercial banks and investment banks, right? They actually made a really nice return. Where they lost money was in Freddie Mae or Fannie Mae and Freddie Mac, which, quite honestly, that money was gone anyway. Right? I mean, that bailout was going to take place regardless because it was basically law that the government had to bail them out. So yeah, in the end, it didn't cost taxpayers anything. But if you ask people whether this is a good thing, no, they hate it, right? And they hate it. And you probably don't remember a lot of the politics associated with this, but the politics were horrible, right? First, it took place very quickly because it needed to. Second, can you see any problem with taking preferred equity? When the government didn't take any voting rights, any guesses what the bank executives did?
Would they have to be more risky because they're getting
They could. They're even, and sometimes it's even worse than that. They just voted themselves big pay raises. They're like, we did an awesome job here. Give myself a big pay raise. Government couldn't do anything about it. They didn't have any voting rights. And so the politics of that were horrible, quite honestly. And a lot of people were justifiably mad about that. that how could these bank executives pay themselves these big bonuses when they're really being funded by the U.S. government? And it was horrible, right? It was very bad politics. And I think in later, people in the Obama administration admitted it, right? That they were so focused on the economics, they did not think about the politics of what was going on, right? And so I think it was the Obama Treasury, the secretary said, we saved the economy, but we lost the public. And I think that's a very good description about what happened, right? That once these perceptions set in about TARP, it was very difficult to change people's minds. So anyway, TARP at one level was extremely successful, right? From an economic perspective, it was very successful and kind of, in some sense, a model for how these things should be run. But in another sense, when the next crisis comes, gosh, will the Treasury and will the federal government bail out banks? I don't know, because the politics of this have been so disastrous, right? Very, not good at all. Of course, the other big thing that came out of the financial crisis was financial reform. And so we need to talk about this. So this was the most important financial reform act in the US since the Great Depression. The biggest change in the US financial system since the Great Depression. And so I want to talk about some of the things that have changed or hopefully changed, because once again, this I think is important to understand and give you some context for these articles that we're going to talk about here in a minute about the COVID economy. So how did Frank Dodd change things? Well, Frank Dodd identified some problems and then introduced regulations to try to fix them. Whether they did or not, history will tell, right? But let's talk about these. Okay, one problem that Frank Dodd Act identifies is the too big to fail phenomenon. Okay, that banks think they're too big to fail, and so they will act with moral hazard. Okay, and so how did Frank Dodd deal with this? In the future, permanent bailouts are not allowed. In the future, if you get bailed out, your bank will go out of business, period. Not immediately, but in an organized bankruptcy. I said chapter 5, this is chapter 13, sorry. For those of you lawyers in the room. What is a chapter 13 bankruptcy? Many firms go through the chapter 13 bankruptcy, and it's basically an organized bankruptcy. So what it means is that the company doesn't close its doors today, but it essentially unwinds its business over time. And so that will have to be what happens to banks in the future. If they go insolvent and they need a bailout, they'll get it. But they're going to have to go bankrupt in the future, right? And it's going to take a while. So Lehman actually went chapter 13 bankruptcy. Now the problem with them is they started like right in the middle of the crisis. They had to start this process, right? In the future, a bank won't have to start this process until the crisis is over. But, it will take years to do this. Just as it took years, I still think there are people being paid by Lehman, right? In other words, there's still stuff from Lehman that's out there being unwound. I actually had a friend who worked for Lehman till like 2012, right? It's like 3 years after it went bankrupt. Because, it takes a long time to unwind these complicated businesses. So in the future, you know, you won't close your doors immediately, but you'll have to close them eventually. Also, a lot more regulatory power has been given to the Fed. The Fed now has power over all financial institutions. And this is something that did not exist before Frank Dodd. There was not one systematic regulator, right? Different banks were regulated by different institutions, you know, by states, by different federal organizations. But there was nobody that was looking at the whole thing. Nobody looking at the whole thing. And now that's really the Fed's job. And so the Fed has a number of things that they do now. Like one of the things, if you read the financial pages like the Wall Street Journal, one of the things you'll see every few quarters is the Fed will conduct stress tests on banks. And what a stress test is they basically get a model of the bank's balance sheet and they hit it with shocks. They say, oh, stock market crashes by 5%, or treasury yields go up by 3%, or this, and they see what happens to their balance sheet. And if it passes, great, but if it doesn't pass, then the bank has to change its balance sheet, right? And so these are kind of things now that the Fed can do as a systematic regulator to try to basically, you know, watch out for problem signs, right? Watch out for problem signs. Okay, another problem. Banks take too much risk. And so here, there's a lot of things that Frank Dodd has done. Some of the more important ones. Banks have been forced to reduce their leverage and hold more capital. Who hates this? Banks. Banks hate this with a passion, right? And so ever since Frank Dodd has passed, banks have spent billions of dollars trying to lobby members of Congress and lobby other people trying to get these things changed, because this has made banks fundamentally reduced stock prices for banks, right? By reducing the return on equity. Some other things, right? And there's a lot of different things here that were passed, but Consumer Protection Bureau. Which more tightly regulates lending practices of banks, particularly with an eye toward protecting consumers, right? So this encompasses everything from payday lenders to some of these people that essentially sold mortgages to people that they knew that they couldn't pay, right? I mean, that's not doing the customer any favors in the long run, is lending them money that they can't pay. So this is a lot more closely regulated. Once again, Republicans in particular hate this, right? Hate this. Ever since this Consumer Protection Bureau has been put in place, there have been many bills trying to get rid of it. There's new rules about securitization. Now, banks can only sell 95% of a loan. They can't sell 100%. Why aren't we going to let banks sell 100% of the loan. Because we want to make sure they have something to lose, right? The idea here, if you've ever heard the phrase, you're always going to get more effort when you have skin in the game, right? That's what we're trying to get banks to do. We want banks to have something to lose. So if they originate a mortgage, they can't sell it all. They're going to have to keep a little bit of that risk for themselves. Derivatives are much more tightly regulated than they were before. Before 2008, it was like the Wild West, right? Banks could pretty much do whatever they wanted. Now there's much stricter rules, and I'm not going to get into the details of all these things because, quite honestly, it gets pretty dense pretty quick. For the same is with trading activities. The kind of trades that banks can get involved in, and when I say trading activities, we talked about this on Monday, right? These trading activities such as trading bonds, trading stocks, trading exchange, foreign exchange, trading financial derivatives. This is a lot more tightly regulated than it used to be. And now it's a lot harder for banks to speculate for their own account than it used to be, right? Banks used to be able to try to speculate for themselves. Now that's much, much harder. We talked about the credit rating agencies. Credit rating agencies are also getting much more tightly regulated. Okay, who's loved Frank Dodd Act? Kind of nobody, once again. Kind of nobody. Nobody loves it. Everybody kind of hates it. Conservatives just say, oh, look at all the regulation. This is so costly, right? And all it's going to do is lead to more credit rationing, and it doesn't make anything simpler because people will just get around these rules. So we shouldn't have them in the first place, right? So that's been the conservative critique. The liberal critique of this is it doesn't do enough. We still have too big to fail, right? And you can say all you want about, having a living will for banks or whatever. I'll believe it when I see it, right? If you really want to have a safer banking system, you have to break up the big banks. That tends to be the liberal critique of this. And so, there we go. Maybe this is true nowadays of most things that are good. Everybody hates it, right? If it's something that both liberals and conservatives hate, that might actually be an indication that it makes a certain amount of sense. And that's certainly the way that a lot of people feel about Frank Dodd, right? But I'll have to say that the evidence so far is that it's working. And why do I say that? Because here we have one of the biggest economic crises in US history, and what's true about our banking system? It hasn't blown up, right? It hasn't blown up. So let's talk about these articles that I assigned to you. The one, this time it's different, okay? One of the themes from this course, and then a banking drama in 3 acts. Now, I did read your summaries, and I think one of the things that maybe you kind of missed in these articles, maybe I should have made this a little bit clear. Well, actually, you know what, now that I see it, it might be a little hard to read, but The first article, this time it's different, was written in April, meaning at the beginning of the crisis. The second article is written at the end of July, meaning more towards we're in the middle of it, right? So the timing here is important to kind of understand what the articles are saying. So let's talk about the first one, right? Which is basically saying, we know we're going to have an economic crisis. How well are we going to do on this, okay? First thing we see this graph, right? What's true about assets of banks since Frank died? They're lower, right? There's lower leverage and more capital, right? And the second page, you see increases in capital, not just in the United States, but also in China and Europe before the crisis took place, right? So throughout the world, one of the things that most countries have learned is we need to have more capital in our banks, right? And so I think one of the most important things that's happened in Dodd-Frank is that most banks have a lot bigger loan loss buffer now than they used to. And so of all these things in Dodd-Frank, I think it's really too early to say the role that some of these other things have played in the crisis. We just don't know enough yet, right? We don't know enough yet. But clearly one of the things, clearly the one thing that's working is that banks have more capital. And so they are much safer, right? They have more capital and they are much less leveraged than they were before the 2008 crisis. And so that has allowed them to kind of withstand some punishment, right? That's allowed them to withstand some punishment. I think the other thing that's different here, and this article spends a lot of time talking about this, is that this time the Fed is on much surer footing about what they want to do. I think last time, in some sense, not that the Fed was surprised, but I think they had to go through a process of experimentation a bit to figure out what worked and what didn't. And I think they have a much clearer idea of what things can work. And so let's talk about what the Fed's response has been here. Because in some ways it's been very traditional, but in other ways it's been not traditional. Right? They lowered interest rates to 0, right? That's not traditional. I mean, that is traditional, cutting interest rates, right? How do they lower interest rates? What do they do, typically? What's the process by which the Fed lowers interest rates? Remember open market operations, right? They buy T-bills. They buy T-bills. So has the Fed just bought T-bills? No, they bought many different types of bonds. Including things that they don't usually buy, like commercial paper. Why? In some sense, the Fed is lending directly to companies. So that they have enough liquidity, right? The goal here is to try to increase market liquidity. So this is different from what the Fed usually does. The Fed usually tries to stick to one corner of the market, T-bills. But here the Fed has bought many different types of bonds and assets. Once again, trying to stabilize markets to make sure that markets aren't panicking. And then the third thing is that remember the Fed is the regulator, right? The Fed is the primary regulator of the banking system. So during this crisis, what do you think the Fed's done to regulation? Tighten it? No. The Fed always wants to be doing the opposite of what the economy is doing, right? So during good times, the Fed should be tightening regulations, but during bad times, they've been loosening regulation. They've been basically loosening up on banks, right? Relaxing lending rules, relaxing accounting standards. A lot of this is very technical, right? But when it comes to financial accounting, there are very specific rules about how things have to be recorded, but those rules can be adjusted. And that's essentially a lot of what the Fed has done. By kind of relaxing some rules, they've essentially been encouraging banks to go lend money, right? The idea here is to try to encourage more lending. So I would say, this is something that's just different than what happened in 2008. First off, banks were much safer. Banks were in much better shape before this. And the Fed here didn't, I don't want to sound like I'm criticizing the Fed in 2008 too much, though maybe a little bit. I think there was a bit of a period of shock at the Fed, right? And things happened so quickly that the Fed, in many ways, just hadn't thought through things enough, right? But come this time, the Fed has a much clearer plan of action, right? Because they learned a lot of things during 2008. And so that really leads us then to the next article about how things have happened, right? The 3 stages. Right? What was stage 1? What? Lockdown, right? Panic. Right? This was March, right around spring break, right? You guys remember that? And what were markets doing during our spring break? Tanking, right? There was a lot of panic selling, right? Collapse in stocks, big collapse in liquidity as demand tanks on bonds and all sorts of assets, right? Just panic. We've seen it before. Here, though, we really had much more effective government intervention and much quicker. The Fed conducted these actions, right? And then there was a big stimulus package passed. Remember, what were some of the big things about the stimulus package that were passed that you've read about?
Small business loans.
Small business loans, right? And to say that they're loans is not quite true. They're really more like grants. I mean, basically they're loans that convert into a grant, meaning you don't have to pay them back if you meet certain criteria. right? You basically have to show, first off, that you suffered big losses as a result of COVID, and you have to not fire people, okay? So those are the two big things. If you do that, then basically, yeah, you can get a loan. Who's loved this stimulus package? Banks have loved it, because how this actually worked is that the government loans the money to banks, and then banks loan the money to individuals, and the banks take a cut. And so this has actually been quite a profitable business for banks here, is turning out these small business loans, right? And so particularly for smaller banks, right, that do a lot of commercial lending, like a Hills Bank or Mount Vernon, these kind of smaller local banks, this has really been a nice business for them, right? They've really enjoyed this. So in that sense, a lot of bank profits have actually remained pretty strong, because they've been able to go and take advantage of customer relations and all that kind of stuff that small banks tend to be very good at. What's the other big thing? Probably nobody in this room but me got one of these. $1,000 check, right? Did this help a lot? I'm pretty skeptical, but it didn't hurt, right? Right? It didn't hurt. It might have prevented some panic, right? It certainly helped people who lost their jobs, right? And so, for reasons I won't get into, I'm not, in general, a big fan of just kind of lump sum giveaways. In part because I think what most people did with this $1,000 check is they just saved it. They don't actually spend it, right? I mean, some people who are desperate will spend it, but most people just put it in the bank, and it doesn't really, you don't get a lot of bang for your buck with it. But, I can't say that this is a horrible idea either. So the question now is, what's stage 3 going to look like? And what does the author of your article say? As we're in stage 3 right now, let me ask it this way. And what's the shape of commercial banks right now? They're okay, right? Commercial banks are okay. But does that mean that everything's okay? Well, what are some of the big worries out there for banks, or just the financial industry in general? What would you be worried about if you worked at a bank?
The duration of the crisis.
Yeah, because what happens is this goes on longer and longer. Things get riskier. Who in particular is in the most danger the longer this goes? People who lost their jobs. What kind of businesses? Smaller businesses that may not have a lot of capital, right, or may have owners that don't have a lot of capital. So there's really, I think, a worry about kind of hidden defaults. Sometimes people refer to these as zombie firms. They're dead, they just don't know it. And so there have been a lot of firms that have been kept alive by the stimulus package. What happens when that runs out? They might really die. And so that's a danger to banks, right? Is that there could be a lot of zombies out there. They don't know. They don't always know, right, how risky some of those loans are, right? Yeah, so anyway, that is undoubtedly one of the big ones. And while you're right, Becca, it's mainly small firms, there could be some There could be some large firms in here. And could, if let's say that a big company announces bankruptcy, I am pertaining no inside information. What happens if Delta Airlines and American Airlines say they're going bankrupt? Okay, I do not want to say there's zero chance of that, because there is a chance of that, right? Their business has been decimated by this. How does the market react? Can this spark a panic? Or will the market just say, well, they were kind of screwed anyway. They were screwed the second this happened, so we're not going to worry about it. Or will they say, if Delta Airlines can go bankrupt, then maybe this company can go bankrupt, right? Hilton can go bankrupt. The Hilton can go bankrupt. Maybe General Motors can go bankrupt, and on and down the line. You never know, right? You never know how people are going to perceive this information and how panic can get sparked. So, yeah, I think that's where we are. I have to say, if you'd ask me, if I could have seen today and you showed it to me in March, I would be like, whoo, that's pretty good. Right? I mean, actually, I think the U.S. financial system and maybe the U.S. economy is actually held up better than I would have anticipated as an economist, right? So in some ways, it feels like, whoo, yeah, we're doing pretty good. But the flip side of this is, how far into this are we, right? Do we have another 3 months of it, or do we have another year of it? Do we have another 2 years of it? Right? The longer this goes on, as Garrett said, the longer this goes on, the more that some really bad things could start to pop up. And so, never forget, banks are risky. And even though banks hold more capital now than they have in the past, that doesn't mean that they can take losses forever, right? I mean, even with holding more capital, there's always the potential that they could get in trouble. And so we'll have to see, right? We'll have to see. But that's kind of where we are today, right? That's kind of where we are today. So once again, when reading these articles, hopefully you're getting some feel for the depth of information that you need to know to be able to read a financial newspaper or something like The Economist, right? I mean, there's just a lot of lingo in these things. They're deep. They assume that you have a lot of institutional knowledge about how things work. And so, yeah, I mean, I don't know what to say to you other than the only way you're going to learn how to read these things is to read them, right? And when you see words or concepts that you don't understand, to look them up online or to ask me or to try to figure it out, right? But really, the only way you're ever going to be able to read The Economist is to read The Economist, right? And Take Money in Banking will help, hopefully, but it's not going to get you all the way there too, either, because there's so much that you really have to understand to be able to understand how financial systems work. But hopefully you're finding reading these articles, somewhat enlightening. And I do think that, the more you read of this stuff, the better you'll get at understanding it. So, okay, so that really takes us through chapter 12. So tomorrow, we're going to talk about your exams here in a second, but tomorrow there is no reading from Michigan. I'm going to send you a reading that I wrote about sovereign debt crises, and then there's going to be a couple of short articles to read and write on, as usual. So we'll do that in the morning, and then tomorrow afternoon I want to do a little econometrics review to kind of get you ready for your third homework, okay? So that will be kind of the agenda tomorrow, all right? Okay, so the exam. Does anybody have any questions, or would you just like me to kind of go through some of this quickly? Maybe I'll go through this quickly, and then you can kind of tell me, where I'm going too quick and if you need more information. So one of the things I noticed on this exam is often on exams, there'll be some questions that a lot of people miss, and other questions that not many people miss. I would say I was surprised by this exam, how there were different questions that different one of you missed, right? In other words, there wasn't kind of a consistent pattern, largely. Though if there was a pattern, I would say that those who struggled on this first page struggled on the exam in general, right? So if you struggled with these definitions, chances are you were struggling with other definitions that were important for you to understand in the other questions. And so, you know, I think this first page was a pretty good indicator of how you're going to do in the rest of the class. So this morning we talked about statistical uncertainty and financial fundamental uncertainty again. The difference between exchange traded and mutual funds. Well, a mutual fund, we'll start with that first. A mutual fund is just a fund that holds a diverse collection of stocks, bonds, and other assets in which you can invest in. You can put your money in that fund. What's an exchange traded fund? Exchange traded fund takes a mutual fund and securitizes it, right? What does securitize mean? Turns it into a marketable security that can be traded on secondary markets. Okay, so really the key is to recognize that exchange traded funds are securitized mutual funds. Idiosyncratic versus systematic risk. Idiosyncratic is a risk that's individual to a specific firm, where systematic risk is risk that applies to the entire market or the entire economy. T-bills and T-bonds, well, short-term versus long-term. But I think the other thing I was looking for you to identify here is that T-bills are discount bonds, T-bonds are coupon bonds, okay? So I think that was another important difference that I wanted you to identify. Question number 2, this was very much a hit or miss. Some of you had no problem with this, and then a number of you had lost a lot of points on this. So explain the theory of credit rationing. Why does it occur? Asymmetric information, right? You can't talk about credit rationing without talking about asymmetric information and how that creates adverse selection and moral hazard. So what do banks do? They lower interest rates so that they can be pickier about who they lend money to, right? How do banks and financial markets overcome this? Well, we talked about a number of ways: through collateral, through getting better information, through getting co-signers, through having regulations on the kind of activities you can engage in. We talked about a couple of others. Question number 3, discuss in some detail 2 ways technology has changed. We actually talked about a lot of ways. I think the 2 ways that most of you talked about was, first, quantitative trading, right, through artificial intelligence and big data, right? That was something that a lot of you talked about. And then second, a lot of you talked about the fact that this has improved information and reduced transaction costs. And I would say those are 2 good examples. And for this question, as well as other questions, I mean, I do really try to read what you wrote. And even if it's not the answer I would have given, if I think it makes sense, I try to give you credit for that. Okay, yield to maturity. So what's the formula needed to calculate a 3-year corporate bond? It has a price of $930. Well, this bond has a 9% coupon rate, so it means it pays $90 a year or $45 every half year. Right? So 6 payments, each of them $45. The last payment you get $1,045. The yield to maturity is greater than the coupon rate. How do we know that? Because the price is less than face value. Part B, what's the current yield? The yearly interest rate divided by the current price. Oops, not 990. About 9.7%. Is the yield to maturity greater or less than this? It's greater. right? Because remember, this is ignoring that principal. And a little or a lot, in this case, a lot, because remember, short-term bonds, the coupon, or I'm sorry, for short-term bonds, the current yield is not as good an indicator. Because once again, you're going to get that $1,000 really soon. And this is completely ignoring that, right? It's completely ignoring that. Part C, what's the T-bill interest rate on the bond selling at $9.90, face value of $1,000, and 200 days to maturity? It's that. And if you calculate this out, you should get roughly 1.8%. Which bond is more vulnerable to interest rate risk? A coupon bond, because longer term maturities are more vulnerable to coupon, or I'm sorry, more vulnerable to interest rate risk. Okay, I would say maybe this, next to the first page, this page was also a problem for some of you. And I don't know exactly why that is, but some of you definitely need to do a little bit more practice with the loanable funds theory and kind of understanding why interest rates go up or down. So question number 5, this is the case of an increase in expected inflation. I think we worked through this exact example in class. I can't remember if we did a decrease in expected inflation or an increase. I think we did an increase in class. And so what we talked about is an increase in expected inflation reduces real interest rates. And so that increases bond supply. That's that. That's that. Increases bond supply and decreases bond demand. So what happens to prices? Prices go down. What happens to interest rates? Interest rates go up. And we call this the Fisher effect, right? You didn't have to say that, but this is what we call the Fisher effect in class. Why is microfinance so expensive? I was only looking for one argument, but there's many arguments. One of them is the transaction costs that are involved. The other is that these are risky lenders. Does this expense negate its benefits? No. Sometimes it's worth having finance, even if it's expensive, if it's something you can count on, right? And so that's really one of the benefits of microfinances. Though it's very expensive, it is still a form of finance that some people can count on. Question number 7, are interest rates pro-cyclical or counter-cyclical? As we've talked many times, they're pro-cyclical. When the economy goes into a recession, interest rates go down. When it goes to expansion, interest rates go up. And what is the graph? The key is both bond demand and bond supply will change, but bond supply changes by more. So bond supply goes down during a recession, and notice that drives up prices and it drives down interest rates. And so that's the reason why during a recession, interest rates go down. The opposite things happen during an expansion. Question number 8, all this question was pretty much just right out of our lecture notes. What's the Gordon growth model? It says that the current price is equal to the current dividend times 1 plus G divided by your required rate of return minus the growth of the dividend. And what are the 2 assumptions? That G, the growth of dividends, is constant, and that you hold the stock forever. Those are the two assumptions. All right, and so if you use this equation, put $3 in here, right? Plug everything in, use your calculator, you get roughly $105. I can't remember what it was exactly, but okay, question number 9. Look at the following yield curve from Greece. Interpret what they are saying. So notice that the yield curve in September 14th looked pretty normal. By normal, meaning it was upward sloping. But what happened in February of 15? It became inverted. So many of you identified that, right, that the yield curve became inverted. But to get full credit, you really have to explain what does an inverted yield curve mean. And an inverted yield curve means that the market is thinking that future interest rates are going to be lower. Why? Because we're headed for a recession. So what this indicates is that the market has seemed to have changed their mind on Greece and expects Greece to be into a recession much more in 2015 than they did in 2014. Okay, and then finally, the essay. Okay, so listen, I recognize these essays are hard. They are hard. Not necessarily because I make them hard, because kind of predicting the effects of things in a financial market can make your head spin, right? I mean, they can. You know, well, this would lead to that, and that could lead to this, and so this leads to that, but that's going to this. And so actually, one of the things, I was very open to different kinds of arguments in your essays, but one of the things I definitely look for is, do you kind of contradict yourself? And that's an easy trap to fall into, right? Where you start thinking one way, and then as you write, you find yourself like arguing exactly the opposite of what you started with. And so, you know, I think that's one thing that I would recommend for the next one of these is strategize a little bit more before you start writing. I definitely have the feeling that many of you just started writing, and you know, you start here and you just kind of stream of consciousness down there, and you end up with something that looks a lot different than where you started, right? And so think about taking some notes here, right? Or you know, really think through a little bit about whether all the pieces of your argument really fit together. So I was open to many different things, but I think there are a couple of facts here that are hard to argue against. First off, even though the Fed has not started buying bonds, I would consider this to be new information, right? So what moves markets? New information. Even if the Fed hasn't started doing this, if the Fed's talking about doing that, it's going to move markets, okay? How's it going to move markets? Well, when the Fed buys bonds, what happens in the bond market? They buy bonds, prices go up, and interest rates go down. So that seems hard to argue against to me. That in general, prices are going to go up in the bond market and interest rates go down. Will it differ across different kinds of bonds? So now this is a question that I don't think there is a clear answer to. I just wanted to kind of see how you argued it. Usually when the Fed buys bonds, what kind of bonds do they buy? The short-term treasury bills, right? So typically you think, well, this effect is going to be biggest in the T-bill market. But if you read the article, it's pretty clear that the Fed is going to be looking at different types of bonds, right? And some of these might be short-term, but some might be long-term. They're not all going to be T-bills. So I would say, will it differ across different kinds of bonds? Yes. It really depends upon what kind of bonds the Fed buys, right? And so I think a few of you kind of made assumptions about what the Fed was going to do, but I think there were more assumptions than, we don't really know for sure. Will the change be different in short-term markets than in long-term? Well, once again, I think you could argue this either way. Typically, because the Fed buys short-term bonds, you'd expect the Fed's action to be larger in short-term markets. But we also know that when there's a change in interest rates, what kind of bonds see their prices change the most? Long-term bonds, right? So once again, I think you could argue this either way. I would consider the best answer to recognize that you could argue it either way, right? There's a reason to think short-term bonds, but then maybe it's going to impact long-term bonds more because of, the relationship between changes in interest rates and maturity. What do you think happened to the slope and the shape of the yield curve? Right? Once again, I think I could be convinced of different things, but to me, if I answered this, I would anticipate the market viewing this as good news. And good news usually means higher interest rates, right? And so I would expect the yield curve to probably shift up, right? That markets would welcome this with open arms, right? That the Fed's going to try to do something here to stabilize the financial markets and stabilize the economy. So yeah, I would expect this to be true. If you had anticipated these actions before the market, what maturities would you have recommended holding? Well, you probably would want to be holding the bonds that you think the Fed's going to buy, if you could beat the market, right? In other words, if you had anticipated this before it was announced, you probably want to be buying the stuff the Fed's going to buy because that's the stuff that's going to go up in price the most. But given that bond prices are going to go up, you probably would also want to hold more long-term bonds than short-term bonds, right? Because once again, which kind of bonds have the biggest capital gains? Long-term bonds, right? So I would say in general, if you think prices are going to go up, hold long-term bonds. You get bigger capital gains. Is the effect of this information likely to be different in the stock market than the bond market? Once again, I was kind of open to different answers. If you view this as good news, which I anticipate markets do, then probably stocks would go up, right? A couple of you made the argument, though, which I can kind of see this, that maybe many people in anticipating this would want to move into the bond market and pull their money out of the stock market. Possibly, right? I think the overall effect of good news driving up the stock market is probably the more important effect, but you're right, that probably would happen too. So, once again, I think this is part of what it means to become a financier or an economist, right? Is not always being able to have the right answer, but being able to kind of think about all the possible answers. And then once you think about all the possible answers, kind of then narrowing it down to what do you think is more plausible and less plausible. And so I think that's always a really good strategy for these essays. And I realize that this is hard, right? This was hard. There's a lot to think about in this. And it's easy for us to kind of get off track, right? And I think for a few of us, we really just got off the rails, right? I think in part because some of us just kind of started writing before we had everything well thought out, right? And so something to work on next time, right? So I realize as a class, we did not do that well on this first exam. And so you're disappointed, I'm disappointed. I also don't think it's Panic City, right? We still have 2 more exams to go, all right? So this is, and when you add in the class participation and the homeworks, I mean, this is a relatively small part of the class, right? So nobody has locked themselves into any grade yet. But, just as importantly as your grade, you want to treat this as a learning opportunity, right? What did I do to prepare for this first exam that worked? And what did I do to prepare for this first exam that did not work, right? So I would expect some improvement in the second exam if you just carefully think about those questions, right? Setting aside how hard you study for the next exam, thinking carefully about what I did that worked and what I did that did not work, right? You'll have a better idea what to expect next time. That will help too. So, all right. So I'm happy to talk with anybody after class. We can step outside and talk, or if you want to talk to me at a later date, send me an email, and we can always meet on Zoom or talk before or after class another day. But other than that, remember, I'll send you an email here a couple of minutes that kind of has your agenda for tomorrow, but we'll be back here tomorrow talking about sovereign debt crisis. Okay, have a good evening.
This number 7 was
Mhm.
was basically the only thing I did wrong with that. I'm like, because I saw my graph was right still, and like, was that still the right like reason? I just basically took it wrong.
Yeah, you're right. I graded this too hard. I think, yeah, I can kind of imagine what I might have done. Having the question mark there, I think I was thinking you were saying interest rates went up, but no, I think you're just,
Yeah,
okay. So how about I'll give you 3 points back on that, okay?
and then I just had a question if this is a 3 or 5. I was just wondering.
That's a 5. That's a 5. Okay, I'm gonna change your grade right here, okay? Okay, got it.